And the CEO actually said that they're soon going to begin deliveries for 2024. And NIO products, he says, are equipped with the highest computing power among production vehicles. So pretty interesting there. And looking ahead to the first quarter is expecting revenue of between 1.48 billion and 1.56 billion.
Challenges, risks, and opportunities. We're absolutely thrilled to dive into the world of NIO's recent stock performance today. Over the past months, NIO has been navigating some choppy waters in the electric vehicle market, with its stock price experiencing notable fluctuations. As one of the prominent players in the EV space, NIO's position is closely watched by investors and industry observers alike. But amidst the ups and downs, the burning question is, what's next for NIO stock?
Yeah, if you look at their data, they're like in the top 3 when it comes to total sales here. So when you're looking at the Chinese EV makers, they're not that profitable, to say the least. Even if you look at BYD, which really focuses on not only EVs, but also hybrids, their margins are very, very low. I mean, you're kind of looking at the same type of ICE type of margins where there could be between 4% to, let's say, 8.5%, 9%. So they have to churn out more vehicles or sell more vehicles in order to be profitable here.
NIO has recently been facing a tough time in the stock market. After the company issued a warning about its deliveries, its stock price took a sharp hit, plummeting nearly 4% in pre-market trading. This decline brought the stock to its lowest level since June 2020, marking a significant downturn from its peak in 2021 when it was one of the top-performing EV stocks. The downgrade in delivery outlook for Q1, with NIO expecting to deliver around 30,000 vehicles compared to its earlier guidance of 31,000 to 33,000 vehicles, added to investor concerns. The situation was compounded by a weak financial report from BYD. Despite surpassing Tesla in China, BYD's profit fell short of expectations, signaling broader challenges in the industry. One of the key issues NIO is grappling with is the saturation of the Chinese EV market, which now boasts over 100 competing companies. Established brands like XPeng and Li Auto and newcomers like Huawei's Ado brand are all vying for market share, intensifying competition for NIO. Ado's M7 model even became the 4th best-selling EV in China, underscoring the stiff competition NIO faces in its home market. In addition to facing tough competition, NIO and other electric vehicle companies are grappling with several challenges. The competitive landscape has forced companies to slash prices, impacting their profit margins. Recent financial results paint a concerning picture for NIO, with its revenue growing by only 1.62% in the fourth quarter to $2.38 billion. Moreover, its gross margin decreased from 8% in the third quarter to 7.5%, signaling further pressure on profitability. Despite expanding internationally, NIO has struggled to gain traction in key markets, particularly in Europe, where sales have fallen short of expectations. Additionally, there are worrying signs that used EVs are depreciating rapidly in the United States and China, further complicating matters for companies like NIO operating in highly saturated markets. Now, taking a closer look at NIO's long-term prospects, NIO's underlying issues suggest a troubled road ahead. The company's bottom-line performance is expected to continue suffering due to ongoing price wars in the EV industry, leading to compressed profit margins. Despite a slight increase in revenue in Q4, NIO's non-GAAP earnings per share fell short of estimates, indicating underlying weaknesses in its financial performance. Moreover, NIO's business model seems unsustainable at its current cash burn rate. Despite receiving multiple rounds of liquidity injections, NIO's operating losses remain significant, raising concerns about its long-term viability. The company's heavy reliance on diluting existing shareholders to raise funds further underscores its financial challenges. These issues are not unique to NIO but reflect broader challenges within the EV industry, where major competitors face pricing pressures and decreasing profitability. With NIO's Q1 outlook falling below consensus and numerous downward revisions in recent months, the company's path to profitability appears uncertain. Additionally, NIO's comparatively low gross and net margins raise doubts about its ability to improve performance without further capital injections. Geopolitical challenges are also impacting NIO's expansion efforts. Seeking to reduce reliance on the volatile Chinese EV market, NIO has been exploring opportunities in other regions. However, its attempts to enter the European market have yielded disappointing results. With minimal sales in Q4 and Q1, NIO's lack of a European manufacturing facility hinders its competitiveness against local rivals. Moreover, the looming threat of a trade war between the European Commission and China poses additional obstacles for NIO. The potential escalation of trade tensions could further impede NIO's ability to penetrate the European market successfully. Similarly, deteriorating Sino-American relations could hamper NIO's prospects in the U.S. market while disrupting its operations in China. Rising trade tensions and potential tariffs on Chinese goods could exacerbate NIO's reliance on the Chinese market, limiting its ability to diversify geographically. Additionally, recent American restrictions on chip exports to China may hinder NIO's self-driving efforts, diminishing its competitiveness compared to other industry players. But before we move on, we just want to thank you for watching this far.
Well, they're needed. This is a war of attrition. And if you run out of capital, and we've seen some companies already struggling with that, Hi-Fi, for example, Human Horizons, has recently stopped production. There have been other brands like Weltmeister, WM Motors that have also run into that problem. In order to kind of weather this very difficult economic period and one with very strong pressure, competitive pressure in the market, you're going to need to burn for a while.
But did you know that Automobility Limited, an advisory firm, also believes that NIO is operating in an intensely competitive Chinese market? They pointed out that there's typically a slowdown at the beginning of the year, with inflated year-end numbers as dealers close. Even with this, NIO had to reduce prices in the second half of last year to maintain growth. The firm emphasized the challenge for all EV makers, including NIO, to sustain volumes amid pricing pressure. According to them, NIO's profitability lags behind rivals like Li Auto and Xpeng. The company's target year of 2025 is to achieve profitability. Regarding new vehicle launches, they mentioned NIO's strategy to broaden its brand portfolio. Initially positioned as a premium offer with a service-oriented model, NIO is expanding into the mid-market with more affordably priced brands. This diversification aims to widen NIO's market and expand into other regions. They also discussed NIO's recent partnership developments, particularly with Volkswagen, backed by Abu Dhabi, which acquired a 20% stake. They emphasized the importance of partnerships to withstand the competitive pressure and capital requirements in the EV market. They see Abu Dhabi's investment as a lifeline for NIO, enabling them to introduce products appealing to a broader market segment in China and overseas. So, where does NIO stand in the current market scenario? While the company saw a significant increase in deliveries in 2023 compared to the previous year, 2024 has brought a different picture. Deliveries in the year's first 2 months dropped by 12% compared to the same period in 2023. Despite being positioned in a more upscale market segment, NIO may still face challenges from lower-cost competitors like BYD, potentially leading to intensified competition and the need for heavier discounts to sustain sales. Looking at the stock performance, it's evident that NIO has been in a downtrend since its peak in June 2021. Recent attempts to buy the dip have not been successful, with the stock dipping below crucial support levels. Technical indicators like the MACD and Chaikin oscillators suggest a bearish outlook, with the next significant support level at $1.13. However, there are still some factors to consider. Despite the challenging market conditions, NIO could see growth in its top-line performance, especially with plans to ramp up vehicle production in the coming months. This, coupled with the stock trading close to a technical support level, could lead to short to near-term appreciation, prompting a change in rating to hold. However, the ongoing price war and macroeconomic challenges suggest that NIO may not be a strong long-term investment option, even at its current price. The change in rating is primarily based on technical analysis, as there are no fundamental reasons to view NIO as an attractive or safe investment at this time. So, will NIO be able to weather the storm and emerge stronger, or are there more challenges ahead for the EV company? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO stock, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.